You walk into a store for one simple item and leave with three. The total on the receipt feels higher than it should, yet in the moment every purchase made sense. Later that evening, you look at your bank balance and feel a quiet frustration that is hard to name. These moments are not random failures of discipline. They follow predictable patterns in how the mind handles prices, value, and timing. Behavioral economics has spent decades studying exactly these patterns, and the findings are surprisingly consistent across different people and different countries. The uncomfortable truth is that your brain uses mental shortcuts to make spending decisions quickly, and those shortcuts often cost you more money than you realize over the course of months and years. 5 specific biases appear repeatedly in everyday life. Each one has been tested in controlled experiments. Each one moves real money out of accounts in ways that are difficult to notice until you look back at the numbers. And each one can be reduced with practical steps that do not require perfect self-control or constant vigilance. Understanding these patterns gives you a different relationship with the money that passes through your hands. Let us begin with anchoring. The first number you see about a product tends to stick in your mind and shape every judgment that follows. In one classic study, researchers showed participants a product with an obviously inflated original price before revealing the actual selling price. People who saw the high starting number were willing to pay significantly more than people who saw only the final price. The brain treats the first number as the reference point for what the item is worth, even when that number was never realistic to begin with. Imagine you are shopping online for a winter coat. The page shows an original price of $320 crossed out, with the current price listed at $179. Your attention keeps returning to the crossed-out number. Without that anchor, $179 might feel expensive for a coat. With it, the same amount feels like a reasonable deal. The difference is not in the coat itself. It is in the reference point your mind accepted without questioning. This effect appears in stores, on websites, and even in conversations with salespeople who mention a higher price first. The initial number sets the frame, and everything after it is judged relative to that frame rather than on its own terms. This effect compounds across many small purchases. Suppose anchoring raises your willingness to pay by $25 on 5 different items over the course of a month. That is $125 that left your account because an artificial starting number influenced your sense of value. Over a year, the total grows larger. The money is not lost to one dramatic mistake. It disappears through dozens of quiet decisions where the first number you saw quietly set the terms. Many people only notice the pattern when they review a year of bank statements and realize how often they accepted prices that once would have felt too high. The countermeasure is simple but powerful. Before you decide, cover or ignore the original price entirely. Ask yourself what you would pay for this exact item if you had never seen any other number attached to it. Then ask what the lowest amount would be that you would accept if you were selling the item to someone else tomorrow. These 2 questions force your mind to judge the object on its actual usefulness rather than on an artificial comparison. People who practice this habit report that they walk away from more purchases and feel more satisfied with the ones they do make. Mental accounting works in a different way. Your brain does not treat every dollar the same. Instead, it places money into invisible categories and then spends more freely from some categories than others. A famous experiment asked people how they would respond if they lost a $20 bill on the way to the theater. Most said they would simply buy a new ticket. Yet when the same people were asked what they would do if they lost a $20 theater ticket they had already purchased, many said they would not buy a replacement. The money was identical in both cases, but the mental label changed everything about the decision. This habit shows up constantly in daily life. You might treat a tax refund, a work bonus, or money received as a gift as different from your regular paycheck. Because it carries a different label, you feel less resistance when spending it. The same pattern appears with cashback rewards, loyalty points, or even the change left in a jar on the counter. The money feels like it belongs in a separate mental account, so it leaves more easily. Over the course of a year, these small leaks add up. Money that could have reduced debt or grown in savings, instead, disappears on purchases that never felt like real spending at the time. A practical way to fight this bias is to collapse the categories deliberately. Once money reaches your main account, treat it as the same pool no matter where it came from. When a refund or bonus arrives, move it into your regular balance first. Then decide how to use it with the same care you give to every other dollar. The simple act of removing the special label reduces the urge to spend it loosely. Some people take this further by keeping only one main account and avoiding separate fun money or vacation accounts that create artificial boundaries. The goal is to make every dollar feel like real money before it is spent. The pain of paying works in the opposite direction. The more clearly you feel the loss of money, the harder it becomes to spend. Credit and debit cards reduce that feeling dramatically. When you hand over physical cash, you watch the bills leave your hand and the remaining amount shrink. When you tap a card or enter a number online, the transaction feels almost weightless. Studies have shown that people are willing to pay higher prices and spend more overall when using cards rather than cash, especially for smaller everyday purchases where the amount feels minor. Consider two people buying lunch each day. One pays with cash and sees the exact amount leave the wallet each time. The other pays with a card and barely registers the transaction. By the end of the month, the card user has often spent noticeably more on the same category of meals. The pain of paying is not removed entirely, but it is delayed and diluted, so the spending continues without the same internal resistance. Over many months, this difference becomes substantial. What feels like a small daily convenience adds up to hundreds of dollars that could have been used elsewhere. One effective countermeasure is to reintroduce friction on purpose. For non-essential purchases, carry a fixed amount of cash each week and use only that cash for discretionary spending. When the cash runs out, the week's flexible spending is finished. Many people discover that this single rule reduces their monthly total more effectively than trying to track every card transaction after the fact. Others choose to leave their cards at home for certain types of shopping or set a rule that any purchase over a certain amount must be paid with cash. These small changes bring the feeling of loss back into the decision at the moment it matters most. Hyperbolic discounting describes how people value rewards differently depending on when they arrive. A smaller reward available now often feels more attractive than a larger reward that requires waiting. In a typical experiment, participants are offered a choice between receiving $100 today or $150 in 1 year. A large share choose the immediate amount. Yet when both options are moved into the future, such as $100 in 1 year versus $150 in 2 years, most people then prefer the larger later amount. The mind heavily discounts future rewards when they are compared against something available in the present. To understand the real cost, Consider the numbers carefully. If you choose $100 today instead of $150 in 12 months, you are foregoing a 50% return on your money over that single year. That is an extremely high rate of return for simply waiting. Now imagine repeating this choice across many different decisions throughout the year. Each time you take the smaller immediate reward, you give up the larger future amount. Over several years, those foregone gains compound quietly. The pattern does not feel dramatic in any single moment, yet the total resources available later become significantly smaller. What begins as a small preference for the present grows into a meaningful difference in financial position over time. The countermeasure is to ask a bridging question before deciding. If both options were moved 1 year into the future, which one would you then prefer? This question removes the emotional pull of the present moment and lets you compare the choices on their actual long-term value. Many people find that simply pausing to ask this question changes their decision in a surprising number of cases. You can also make the future reward more concrete by imagining what you would do with the larger amount when it arrives. Turning an abstract future sum into a specific plan reduces the tendency to discount it too heavily. The final bias is the Diderot Effect. When you acquire one new item, it often creates pressure to buy additional items that match or complement it. The original purchase changes your sense of what belongs in your life, and new purchases follow to restore a feeling of consistency. A person who buys a new sofa may soon feel that the old lamps and rug no longer fit the space. The sofa itself may not have been expensive, yet the chain of follow-on purchases can become far more costly than the first item. The effect is named after a French philosopher who received a luxurious robe as a gift and then felt compelled to upgrade everything else in his study to match its elegance. This effect appears in ordinary situations when one upgrade triggers others. A new phone leads to a better case, then a new screen protector, then perhaps a different bag to carry everything. Each individual step feels reasonable on its own, yet the total spending grows well beyond the original plan. The purchases feel connected and therefore justified, even when they were never part of any budget. The same pattern occurs with clothing, home goods, electronics, and even hobbies. One new item quietly raises the standard for everything around it. The countermeasure is to impose a deliberate waiting period after any non-essential purchase. Commit to 30 days before buying anything that would match or complement the first item. In most cases, the urge fades, and you discover you can live comfortably without the additional pieces. The waiting period breaks the chain reaction before it gains momentum. Some people take this further by keeping a list of items they considered buying during the waiting period and reviewing it at the end of the month. Most of the items on the list no longer feel necessary once time has passed. These 5 biases rarely appear in isolation. They often reinforce one another in a single spending decision. An anchored high price combined with mental accounting can make a purchase feel like it belongs in a special treat category. The reduced pain of paying with a card then makes the decision feel easier. Hyperbolic discounting pulls you toward enjoying the item immediately rather than waiting. Once the item is home, the Diderot effect may quietly begin the next round of spending. A single afternoon of shopping can activate all 5 patterns at once, which is why the total often feels surprisingly high when you review the receipt later. Becoming aware of these biases does not remove them completely, but it changes the default setting. When you notice an anchor, you can deliberately ignore it. When you feel tempted to treat certain money as different, you can move it into your main account first. When the pain of paying is missing, you can add friction on purpose. When the present moment feels urgent, you can ask what you would choose if both rewards were delayed by a year. And when one purchase seems to require others, you can pause for a month and see whether the need remains. The money that stays in your account is not usually the result of earning more. It is the result of losing less to patterns you now recognize and can interrupt. That difference compounds quietly, month after month, in the same steady way the original biases once worked against you. Over time, the small adjustments protect more of your income without requiring extreme discipline or constant vigilance. The goal is not to eliminate every purchase you enjoy. The goal is to make sure the money you spend is the money you actually meant to spend when you look back at the end of the month or the end of the year.